Joining us now to share his commentary on the day's market performance is Culverwell from Anchor Capital. Sean, thanks so much for your time this afternoon. You know, it seems like the U.S. government shutdown has somehow been swept under the rug. It's been over, a month now, and not much market reaction. Is this something that's still on your radar? I mean, there's still no end in sight.
Yeah, I think it's just adding to some angst in the broader market with valuations very stretched and ongoing corporate releases being quite mixed at the moment. But as you said, it has been swept under the rug with headlines capturing other news at the moment. But we're on our 37th day of the shutdown. So it is the longest shutdown in history and likely to be the most damaging to the economy. Difficult to get sort of any true estimate of what it's doing to the economy, but Goldman Sachs put out a number yesterday saying that they expect it to bring down the growth of real GDP by 1.15 percentage points in the fourth quarter. So it is noticeable, and it is a concern.
Something else that has been hogging headlines are those tech counters. AI bubble concerns are back on the table. You mentioned it there, and spilling over into broader equity markets. Are you concerned about the downturn we are seeing in those counters, or have these stocks just run too much and we're seeing a healthy pullback?
I think the market, specifically that concentrated part of the market in the AI plays, was overdue a healthy pullback or a period of consolidation. But as I just mentioned, the total environment at the moment is quite uncertain with the shutdown, with the weak Chinese data we got this morning, and then just no visibility into the US economy. So with all of those factors taken into account, plus the stretch valuations, that sector of the market is the easy place for investors to take profits at the moment.
And that brings me to my next question. You alluded to those Chinese figures out today, export figures, that is, where we saw exports slip over 1% in October. Shipments to the US declined 25%. Just your thoughts on that print. Are we starting to see the front-loading activity we saw earlier in the year tapering off? Is this more of a normalized export picture?
I would say so. So obviously they did try to get as much product out as possible in anticipation for the implementation of the tariff. So that's certainly having an impact. But I would also say it's a reminder of China's reliance on the US consumer, given how big that decline was. But the magnitude of the decline was surprising. So as you said, shipments to the US was down 25%. But another concern is that exports to some other key markets, so South Korea, Russia, and Canada, also contracted by double digits. So it could be underscoring just broader sluggish global demand and leaving prospects for a meaningful recovery within the export sector in China uncertain at this stage.
And that, of course, would also filter through to the overall growth numbers, looking at what's happening domestically in China, where consumption has also been downbeat. So something to track when we get the next GDP print out of the Asian country. In company news, let's take a look at what's been playing out in the pharma market, particularly operators in the diabetes/weight loss market. Trump striking a deal with Novo Nordisk and Eli Lilly to lower prices. The companies will also get relief from tariffs for 3 years as part of that deal. Is this a good trade-off? And if so, why aren't we seeing much action when it comes to share price movements? The last time I checked Novo's share price, it was down over 2%. Is that just lending itself to what's playing out in the broader market and not necessarily the deal with the Trump administration?
So first, I would say it's a net positive, this deal that they've struck. There have been some market concerns about price reductions, but now you effectively, with this deal, trading a manageable price cut for a very meaningful unlock in coverage. So they both get access to the Medicaid program and the Medicare program. But Novo, I would say its share price is down due to primarily its own issues with very weak results.
Now let's take a look what's playing out on the local company news front. You mentioned there Novo coming out with weak results earlier this month, or was it last month? I think it was either last month or earlier this month. What we're seeing here at home in another sector, in the retail sector, is TFG out with numbers. HIPs declining 21%, struggling in key markets, including here at home, South Africa. How much of this is due to tough competition, and how much of this is due to what we're seeing playing out when it comes to the constrained consumer in the country?
I think both factors are having a big influence. You've seen Truworths results yesterday, also noticeably weak. So the sector in total is struggling quite a bit. But also, yeah, I mean, the results were weak, but obviously well guided. I think what the bigger issue is how the weakness was across regions and not just in South Africa. So Oz was weak, UK was weak. And in my view, yeah, I think the Fashini investment case is not one I would want to participate in right now, because they had a capital markets day early in the year where they did post some aggressive margin targets. And based on these results, it looks like it's going to be a long while before they get anywhere close to that.
And how do you think TFG fares against the likes of Truworths, which was also up with a downbeat update this week? I think the only update that was quite positive was Pepkor's one.
Exactly. But I think with Pepkor, you have that burgeoning fintech business, which is really lifting the broader group and is a nice growth driver to them. Also with Truworths, it seems like the UK business, the office is doing a lot better than TFG's core UK business. So that's providing an offset. But in terms of the base South African businesses, both of them are very, very much struggling.
All right, let's get into your stock pick. Where are you seeing value at the moment?
So I quite like Clicks at the moment. So despite them reporting very strong results recently, they've derated to a 22 times to 23 times forward multiple. And if you look at the chart over the last 5 years, the group's multiple has troughed at this level about 4 times before re-rating. Also, I think, yeah, the fundamental outlook does remain very strong. They should report very good results in April, with the first half expected to reflect 5 to 6 more store openings than the prior period. And then also their store openings in their 2025 period was very much weighted to the fourth quarter. So the full benefit of that is expected to come through. At the same time, their balance sheet is up to 3.2 billion net cash, and they have been active with buybacks. So you could see the buybacks pick up now with the valuation coming back, and that should be a strong underpin to HIP's growth. And you just know with the Clicks management team, their execution's always flawless.
And I think Bettina said, the CEO of Clicks, that it said they'll have 1,000 stores before the end of 2025. So I can imagine how much that'll bring to the book come the next financial year when they're out with results. Sean, let's leave it there. Thanks so much for your time and sharing your insights with us this afternoon. That was Sean Culverwell from Anchor Capital.